A lot more earnings. So let me also welcome on board Ramesh Iyer from Mahindra Finance on the show right now. Ramesh, good to chat with you as always. Just going through your performance, and you've reported a loss during the quarter. Clearly there seems to be an impact of the COVID second wave. Did you see the second wave impact all segments that you're currently present in, or was it very specific?
So clearly, as you know, we do a lot of work semi-urban rural market, and rural was the most impacted in this second wave. And also it's important to understand the segment of customer we work with are all earn and pay segment, which means they are either in goods movement or they are in people movement. And therefore, when there is a lockdown across the country, out of the 90 days, hardly people could work for 15, 20 days, and that also part-time. So if that's going to be the situation, it is bound to be that the customers will have this pressure of not earning enough to be able to discharge their liability. But then you look at the profile of this customer. These are customers who in the past have paid very regularly, and they were very standard accounts as of 31st March. Now, when there were one installment outstanding or maybe two installment outstanding in March, suddenly you have 3 months of such a situation where they can't earn to pay. It is bound to be going into the NPA. Now, there was a possibility of restructuring accounts, but our feeling, and the customer themselves are saying so, is that if things are going to get normal in a month or two, why do you want to restructure, and why do you want to burden us with higher interest going forward? So we have also taken the view, and we looked at the customer account movement, and we've seen a very large number of accounts have already paid more than 50% of their loan in the past. So hardly there is any liability left to worry about. Second is, even during this 3 months of difficult time, as much as they have been able to earn, some of them have discharged their liability. So we've taken a very clear view that these are extremely good customers. And therefore, even if we have to show them as an NPA by the regulatory requirement, that's fine with us. And we have made a substantially higher provision. And very, very confirmatorily, I can tell you that as things starts to open up in the next 3 quarters, you will see a reversal of all that is being done. So I think it's not to be looked at as a credit-based NPA. They are all liquidity pressure-based NPA, and therefore they will reverse in the next 2 or 3 quarters.
So just wanted to understand, Ramesh, whether or not you're getting a little bit cautious about lending, or is that not the case? Also wanted to understand, how is it that you're seeing the demand situation currently pan out amidst the segments that you're currently present in?
So I think, every time these questions come up, is the growth stunted because you're overcautious, and are you trying to not participate, etc. But we shouldn't forget that we are just an enabler, right? Unless the vehicles and tractors and pre-owned vehicle and all of that gets sold, there is not a role for us to really play. We don't want to be seen as who's, kind of generating sale through providing credit, because that may not be the right approach. So there has to be a fundamental demand for the credit to enable that demand to be fulfilled. So last whole year, if you see, clearly the availability of vehicle was an issue in that market, and nobody knew what's the impact of COVID-1. So there was definitely a slowing down happening and wait and watch situation. Post that, I think between October and March, we start seeing things to become normal. The demand started picking up, and we also participated in the demand. Unfortunately, the second wave come and hit it very, very hard. But dealerships were shut, RTOs were shut, people couldn't move. So obviously the sales, went down. When we saw June opening up, we saw volumes coming back. Inventory levels are good. Customer sentiments are returning back to normal. They are visiting showrooms for buying vehicles, etc. And clearly we are seeing the trend going forward. I've said this before, and I'm saying it again. You will see the demand during festival will be one of the best. I would think that's a turnaround time to watch. These 2 or 3 months, things will stabilize, settle down. And you will see post-October, there will be a substantial demand happening, and we would benefit from those demand in that market.
Mr. Iyer, we take your point in terms of your expectation that things will improve rather quickly going forward, but then gross NPAs have reached over 15%. Could you give us an idea as to how you see that ratio moving over the next couple of quarters? And also, given the uncertainty of the third wave, are you increasing your provisions ahead of time?
So let me kind of clarify. this increased NPA that we see, and we don't have to really even go that far to see how it behaved then. Just take the COVID-1 situation. If the moratorium was not there, the gross NPA would have looked similar to what it is looking today. And then you look at post-moratorium, all the customers came back to normalcy, and between October and March, we saw collection efficiency every month over 90% plus. And that's how the NPAs stabilized at that 8-9% as of March. I don't think you will see a very different situation. And I'm repeating myself that April, May, June, what we see as an increased NPA are not credit-based NPA. They are liquidity pressure of the customers, which they temporarily went through due to non-earning. You will see this reverse in the next 3 quarters as market normalizes in the rural market. So this has to be seen in that light. So I don't see that a problem at all. And related to that, therefore, even at this level of gross NPA of 15, we have consciously made substantially higher coverage, and we are at 53% coverage to this level of NPA. So just imagine that the gross NPA drops from the current level by even 4-5% in the next 3 quarters. We are substantially over-provided, and therefore it's a right-back situation we would look at rather than providing for more.
Okay. Point taken, Mr. Iyer. When it comes to Mahindra Finance, growth, of course, you have to be a bit perhaps cautious, especially how segment, is, especially how, credit is moving in India. Now, my question is, would there be need of prudent capital raising over the next 1 year?
Capital adequacy today it is 23% and tier 1 is 20%. So after making these kind of provision for the losses, so I think we are sufficiently and adequately capitalized. I think what we are really looking forward to and waiting for is the turnaround in the market for growth to pick up. And then you will see an aggressive growth happening from that market, which will also help better recovery, because this is a very unique market, which I would like to leave you with. As disruptions happen, these customers do get impacted the fastest and the steepest. But as things begin to change, they bounce back also with the same speed. And the easiest example would be, take any year when the monsoon has failed. The customer goes through very, very difficult time and the NPA goes up, and immediately it picks up as the season comes to normal. And you will see a similar trend. So that's what we are waiting for, that the normalcy returns and things get to absolutely positive trend out there. And the last comment would be, when you see growth return, you will also see improvement in collection, because that's a direct reflection of the improvement in the cash flow.
Okay, well, Mr. Iyer, we leave it at that. Thank you so much for joining us this morning on ET Now and, talking to us about your Q1 performance. And with that, we're out of time as well. So from Aisha, Alex and me, it's a goodbye. Thanks for watching.